Hi, this is a webinar brought to you by 4 Lines, and in this webinar we're going to be discussing ETFs and mutual funds. The content of this presentation will include an introduction to exchange traded funds, an introduction to mutual funds, then we'll consider the benefits and drawbacks of ETFs, and also the benefits and drawbacks of mutual funds. And finally we shall compare the two and conclude. Before we start, I must say this material in this presentation should not be taken as investment advice. Do not use the material as the basis for any investment decisions. The examples are all theoretical and only used to explain the concept of low-cost passive investing. Thank you for listening. Okay, so the primary objective of most ETFs is to replicate the performance of a market index. The first ETF traded on the US exchange was State Street Spider with the ticker SPY. It was introduced in 1993. The SPY tracks the S&P 500 index and is currently the most heavily traded security in the world. Indexing is an investment strategy which supports the view that over the long term an investor is better off following the market rather than attempting to beat the market. Due to the growing prevalence of this investment strategy, ETFs have grown in popularity. Investors like ETFs because of their transparency, liquidity, tax efficiency and low cost. This has led to the availability of ETFs across different asset classes, investment styles and geographical area. As a consequence, it's now possible for investors to build a low-cost, well-diversified portfolio just using ETFs. A mutual fund is a management investment company which pools investors' money to meet a desired investment objective. It is referred to as an open-ended investment company as it does not specify the exact number of shares it intends to issue. The open-ended investment company can raise an unlimited amount of investment capital by continuously issuing new shares. A mutual fund's net asset value is calculated at the end of the trading day. To invest in a mutual fund, the investor places their order during the day, but has to wait until the end of the day until the fund has calculated its net asset value before knowing what price they have bought the shares for. When an investor sells their shares, they are redeeming them directly with a mutual fund, and so a mutual fund will generally keep a level of cash to meet these redemptions. However, for large redemptions, the fund may need to sell some of its own shares to pay back the investor. So let's have a look at some of the benefits of ETFs. Well, they're very simple to trade and can be traded during the day just like a stock. They provide a means of quick diversification, opening up multiple asset classes with affordable operating costs. They're economical and have low expense ratios compared to other mutual funds. The creation of units by an authorised participant are exchanged in kind for the ETF shares. These redemptions of this in-kind transaction does not create a capital gains tax liability for the ETF, and so no unwanted gains are passed on to investors. Only brokerage house fees are payable when buying or selling an ETF on an exchange. An investor can track their investment value in real time. There's great transparency in the holdings, which are published daily. And finally, there is only one type of share class, which keeps things simple. So let's look at some of the drawbacks. Index tracking ETFs will never beat the market. In fact, ETFs will slightly underperform the market once they adjusted for fees. Whilst the creation and redemption process for ETFs creates a tax advantage, it simultaneously introduces the ability for ETFs to trade at a premium or discount to their net asset value. There are often operational nuances to the way ETFs are structured that can introduce operational risks. Investors always need to read the offering memorandum and be aware of these issues. ETFs do not offer dividend reinvestment programs. So let's have a look at some of the benefits associated with investing in mutual funds. Many mutual funds are actively managed, with a team of specialists seeking to generate market outperformance by identifying undervalued securities from a relevant range of stocks and bonds. Many mutual funds have been in existence for longer than many ETFs, and so have longer track records. An index tracking mutual fund will have similar low operating costs to an ETF. Mutual funds do not trade at premiums or discounts and are settled at their net asset values at the end of the trading day. They generally offer good liquidity, as the fund is obliged to honour the redemption at the end of each trading day. So let's have a look at some of the drawbacks. Well, whilst trying to beat the market, many mutual funds materially underperform the market after fees. In fact, in aggregate, active management must underperform passive strategies due to a theory called accounting equilibrium. If you express it another way, outperformance is always a zero-sum game. Someone is only winning if someone else is also losing. Many mutual funds have seemingly high sales lows, which already on top of management fees may be incurred when an investor either enters the fund, exits the fund, or incur them on an annual basis, as the fund compensates the financial advisor for providing their unseemingly unbiased advice when advising which funds are appropriate for their clients' money. The lower cost index mutual funds still have higher expense ratios than their lower cost ETFs cousins. Mutual funds are not tax efficient. Active trading drives more short-term gains, which generate a higher tax bill, and also large redemptions can lead to the fund passing on unwanted capital gains to shareholders. It's always wise from holding off from making an investment in a mutual fund until you've attained whether the fund has a capital gain tax liability coming down the pipeline. Mutual funds have more than one type of share class, which can complicate things for some investors. For example, different share classes levy different types of charges. Shares can only be traded at the end of the trading day. In a volatile market, an investor may want an immediate execution. Mutual funds are only required to reveal their holdings on a quarterly basis. Now, many provide details every month, but this is still willfully poor compared to the daily transparency offered by an ETF. And some funds stipulate a minimum level of investment, which may seem high for some investors. Okay, well, I've explained some of the benefits and drawbacks of both ETFs and mutual funds on the previous slides. Now this table is just going to generally summarise what we've already spoken about. Now, I'm not going to go through all of this again. What I would advise you to do is pause the video now and then come back for the final conclusion. Okay, so what are our conclusions from this webinar? Well, firstly, I think it's fair to say that over the long periods, mutual funds rarely outperform the market as they face too many headwinds. For example, the ones I've already gone over are taxes and the fact that they charge higher fees. ETFs provide the basis for unbiased financial advice, as there's no kickbacks, which are often paid to a financial advisor when they advise their clients to put the money in a mutual fund. ETFs are a better risk management tool. This is because, generally speaking, they provide better liquidity, as you can trade them just like a stock during the day. And generally speaking, ETFs have a lower expense ratio than a mutual fund. They're also structured to provide tax efficiency, which is lacking in a mutual fund. I think finally we can just say that ETFs are a lot more transparent than mutual funds, providing really daily transparency on their own web pages. Okay, so that's it. I hope you enjoyed this webinar, and thank you for listening.